Good morning, good afternoon, good evening, everyone. Welcome to another episode of Smokin Bulls. My name's Tyler.
I'm Dave.
And today we have the opportunity to speak to Dimitri Silva, portfolio manager with Reams Asset Management. And we get to access Reams through a company called Canoe Financial. Canoe is a company that Dave and I have partnered with in the past. And we're joined also by Wayne Myers from Canoe Financial. Wayne's a boots on the ground for us and a huge support to our business. So we want to thank you for being here, Wayne. And I'm going to turn the floor over to you so that you can do a bit of an introduction of both Canoe and Reams and Dimitri, and then we can kind of get rolling into his conversation points today. So take it away, Wayne.
Thank you, guys, very much for once again inviting us onto your podcast. It's great to be able to speak to you, your clients, and prospects. Just to give you a quick overview of who Canoe is, we are a 13-year-old business as of Valentine's Day recently. We currently manage over $15 billion in assets and have been Canada's fastest growing asset management firm for 4 straight years now. We are 100% Canadian. We are also 100% employee owned. As we manage our portfolios, we tend to like to have the internal funds managed where we have the expertise. But there are areas where we do not have the expertise. So we were looking for specifically an unconstrained bond manager. And so we started a search just over a year ago. And that led us to what we found was the top unconstrained manager that we could find, in that when there were actual market moves or environmental changes in the market, we noticed that there was a firm that actually made changes in how they managed the money. And we thought that was refreshing. So that brought us to Reams out of Indianapolis. What we really liked about Reams is they present us with an opportunity to provide investors with unconstrained bond exposure that is uncorrelated to other markets, that is truly unconstrained and leads to low downside capture with high upside capture. Today, we have Dimitri Silva from Reams to talk to you about the various aspects of fixed income, about the firm, and where we might be from a market perspective. So at this point, why don't I turn it back over to you guys so you can direct through questions with Dimitri.
Sounds great. Thanks, Wayne. So we've got a bit of an understanding on what you're doing over there at Reams, Dimitri, but we're going to dive a lot deeper on some of the work you're doing there. So maybe I'll just let it turn over to you for now, and you can introduce yourself a bit more and a bit about the work that's happening over at Reams.
Sounds good. Thanks, Tyler, and thanks, Wayne, for the introduction. So Dimitri Silva, been in the business since 2007, been a portfolio manager since 2012. My first 15 years in the business was at AllianceBernstein, a firm out of New York. Joined Reams about 3 years ago. I'm a managing director and head of global rates and currencies here at Reams. Reams itself has been around for about 41 years to be exact. Only fixed income manager. We have 8 different strategies, but all within the fixed income area. Manage roughly about $27 billion in assets. We have a core plus strategy. We have two what we consider our flagship strategies. One's a core plus strategy, which has been around since our inception, so more than 40 years. And the other one is, as Wayne talked about, and is kind of what the Canoe Fund is invested in, is our unconstrained strategy, and that's been around since 1998. One of the longest strategies, unconstrained strategies in the U.S. And a great track record. Over 8% returns since that period, which beats high yield by 200 basis points, beats the U.S. Ag, which is in the fixed income benchmark, captures broader market fixed income in the U.S. by about 4%. So have a long track record, have a very good track record, and we think we invest philosophically slightly differently from most of our peers, and we've got a team that has kind of followed that philosophy and playbook, as we like to call it, for consistently over that period, and that has given us an advantage of to be able to generate these, as Wayne mentioned, uncorrelated returns that are also tend to give you a good bit of the upside capture without taking a lot of the downside. that's kind of a quick overview of Reams.
Well, that's great. I mean, our access to it, of course, is through Wayne's firm at Canoe. That's the Unconstrained Bond Fund that we're most interested in. It's wonderful to hear the time frame or the history that's following you with Reams. That's a long period of time to be working in the fixed income markets. And just like our clients and ourselves, fixed income is often not something that is looked at as really sexy or entertaining, I guess, when it comes to investing strategies. But if you guys have a unique process, maybe you can tell us a little bit about that, about what makes your fund a differentiator when it comes to the fixed income market and how it pairs with other products out there nicely.
Well, sure. So, let's start. Let me talk about our philosophy and how we manage money, and then hopefully that kind of illuminates how we differ from some of our peers. Sure. First up, our philosophy is basically has two key pillars. First one is that we believe in being disciplined fixed income value investors. And the second pillar is that, we really focus on avoiding downside impairment. And that's kind of our focus in terms of risk. Let me dive a little bit deeper into that. First, in terms of what do I mean by being a disciplined fixed income value investor? What I mean is that over time, what you should expect from us is that our exposures to the big fixed income factors, whether it's overall credit risk or overall duration risk, or even exposure to certain factors within certain sectors within the fixed income market, you should expect it to vary significantly over the cycle as valuations change. That is the primary driver of how we invest, and that as those change over time, we tend to vary our exposure very significantly. To give you some examples, if you think about our overall credit exposure, that's including investment grade corporate, high yield corporate, securitized exposure. If you try to kind of capture all of that and turn it into one beta number, and we like to look at it versus US high yield as an index. It doesn't really matter what the index is, but to give you a sense of the range, in the last 10 years, we've been as low as 3% beta to the high yield index, and we've been as high as 83% beta to the high yield index over these last 10 years. So, and what's driving that? It's valuations. That's what's driving that. Similarly, in the rate space, what we find with a lot of our peers is they tend to be, they call themselves unconstrained, but don't really move the duration dial that much, tend to be low duration throughout the cycle. For us, it's very different. We look at that as another lever. For us, value within the fixed income space or in bonds comes from real rates. That's our measure of value. And when, real rates were close to negative 2%, intermediate real rates, 5-year real rates were negative 2% back in 2020 and 2021. We were short 3 years of duration in the portfolio. And compare that with, just a few months ago, when real yields got to 2.5%, when, in October of 2023, our duration was up to 7 years. So it's ranging very significantly. And that applies not just to the big fixed income factors. It also, it's a similar in terms of exposure to sectors. For example, if you think about the mortgage-backed security, agency mortgage-backed security sector in the US, for a long period of time, if you look at the last 10 years, we had zero exposure to that sector. The reason was because the Fed was doing a lot of QE, and that was one of the assets they were buying, and they were really suppressing vol, and that sector had no value in our view. But what happened obviously in 2022 and 2023 was the Fed started getting out of that market, number one, and some of the big holders within that market, especially commercial banks, which had kind of gorged on that debt during those 2020, 21, 22 period, started selling some of those bonds, and it became really attractive, not just on absolute basis, not just on a relative basis, but also on absolute basis. And, having basically zero exposure for the better part of 10 years, we have 30+% exposure to the sector right now. That gives you a sense of how we vary our exposure through the cycle. And so that's kind of what I mean by being active fixed income value investors. That's number one. What does that not mean? What does that not mean is that we're trying to, we're not picking the top and the bottom for markets. That's not how we invest. What we're doing is we are reacting to market opportunities. We're not trying to predict the future in any sort of way. We're just reacting to, hey, what type of risk premia is the market paying us to own this asset? And then allocating capital as a function of it. Now, why do that? Why does this philosophy make any sense? It's because fixed income factors tend to mean revert over time. For example, if you look at what we consider our preferred habitat, we tend to buy over the cycle, an average holding for us would be a triple B intermediate corporate bond. That would be kind of an average holding over time. Now, if you looked at the spread compensation that you earn for that bond over the long term, but only about 10% of that really is for default risk. 90% of that is really coming from mark-to-market risk and liquidity risk and other risk premia that basically tend to mean revert with time. So when you are a disciplined value investor, what you're playing is mean reversion, and this trade makes a lot of sense. It's a very high hit ratio trade that we think even would this playbook, very simple playbook, would even work well in the Great Depression. And that's we try to look at history and understand what types of risks we're taking. And even in the Great Depression, you had something like maybe 7% default, 7% loss given default for triple B corporate bonds. But the average spread that you earn on a triple B intermediate bond is somewhere close to 140 basis points on an annualized basis. So over a 5-year period, you are earning more than what you lose on defaults, even in the Great Depression. So that's why we kind of that's one of the key pillars of what we do is to focus on that value discipline. The second feature of what we do is basically focusing on avoiding permanent impairment. Now, how do we do that? A lot of people say that, but how do you do that? For us, we do that in 3 ways. Number one, we tend to stress test every single bond that we own and stress it for economic, a stressful economic environments like a 2008 like scenario. And we look at can this bond survive that sort of shock to the system? And if it can't survive it, we just don't buy it. And as a function of it, we don't own certain sectors. For example, we have no exposure to things like retail, apparel, long duration technology bonds. We have zero exposure to it because it's very hard for us to kind of gauge what the downside risk is for those sectors. So we kind of avoid them. Second, we tend to be investing. We like bonds that have good structural attributes to it, have good assets that are backing those bonds. For example, we like sectors like first mortgage bonds or EETCs in the airline space, or things like insurance gigs. These are bonds that have assets that are securing them in some sense and are high quality in that sense. So even if the bond does default, the loss that you're going to take in that sort of environment is going to be low. So that's another way we do it. The third way we do it is to avoid. We don't believe in structurally subordinating ourselves for the sake of income. Fixed income is already a very negatively convex asset. Best case scenario, you get some principal, you get your principal back and some coupon, right? But the downside, it goes to zero. So to us, adding structural leverage to that is not a great idea. So we avoid, if you look at our corporate bonds, we tend to be in the senior unsecured and higher part of the capital structure. If you looked at the securitized space, which has a lot of leverage, we tend to be at the top part of the capital structure, the triple A part of the capital structure. So these are basically ways that we kind of try to build a portfolio where the single securities that we buy are high quality in nature and unlikely to default. So this philosophy of trying to avoid permanent impairment, we've done consistently over the last 40 years, which is why we had no losses from subprime mortgages in 2008. We had no losses from Credit Suisse AT1s in last year, right? We didn't have losses. We don't own any double B and triple B CMBS bonds that are now at risk right now as we talk, right? We don't own any of those sectors because of the fact that we do not get comfortable with the downside of them, and we shy away from them because it's not part of our strategy. So if I sum up the overall strategy, it's a top-down strategy that is, when valuations warrant it, aggressive. It will be aggressive, but we are marrying that with a conservative bottom-up security selection. So basically what we're doing is playing mean reversion in some sense, but playing mean reversion with only assets that mean revert, right? We're not trying to play mean reversion with high yield, triple C bonds that default and go away. Then you can't play mean reversion in that strategy because you're not going to be around to be able to get the upside. So it's a very simple strategy but simple playbook that has been executed consistently and well over the last 40 years with a team that has really been together, who've worked together. We have very low turnover in our investment team. If you look at it, over 15 years of average experience on the team itself, being as part of the team, which makes the team really cohesive, understand how to how to interact with each other and to make the best of especially during stressful times. Each person's strengths and weaknesses, and you know how to, as a team, work to a good outcome, and that kind of really is a positive for the fund, and it's a strategy over the long term. So it's a combination of a simple playbook executed really well by a team that's really comfortable doing uncomfortable things. Right? We are happy to buy when everyone else is saying sell everything and go to cash. And when the market's really expensive, like in a 2017 scenario, we're happy to say, okay, fine, the party's over. We're happy to go into high quality assets and stay away. We don't need to earn additional carry. So in some sense, to try to differentiate, as you asked, Tyler, how does that differentiate ourselves from our competitors? One was the type of securities we buy. As I told you, we don't end up buying these lower quality assets that we think have, a lot of default risk, number one. Two, we are really tactical managers who will move up overall exposures around with time. Unlike some of our peers who tend to be more income focused, tend to be fully invested throughout the cycle. It's a different way of investing, which is that we don't think that's not the way we like to do things, and we just think that there's value to be added by being really tactical and taking the opportunities that the market's giving you, because these cycles of fear and greed are going to be around for well past forever for the most part, right? So in that environment, we think this is something that we can really take advantage of and generate returns for our clients with.
It's when we look at how we position. I mean, we have three main portfolios we work with. One's fixed income, one's equity, and one's alternatives. And there's this last 5, 6, 7 years, you starting to lean on your alternatives a bit to make up your fixed income lack of ability, but I think that increases the risk. So when we look at what's been available to us and what we use for our clients in the equity side, we have lots of unconstrained holdings that we have that allow the manager a lot of freedom. And when we look at our fixed income space in Canada, anybody who is using an advisor or tries to manage this on their own have very limited opportunities to be positioned in a fund that allows that kind of flow that Reams is doing. I mean, we do have other bond funds. They all have, I guess I could call them, they're somewhat unconstrained, but that's to 10%, 15%. There's a bit of latitude there, but they are just focused on an overall standard bond structure with a little bit of play, I guess, allowing them to make some of those changes that you're making. So the fact that the way that you've run this fund for quite a period of time it's a good piece for a fixed income portfolio. Everybody still needs a portion of their portfolio to be fixed income. We know how it goes when the markets get good. Nobody wants to own a bond, and when times are really tough, nobody wants to own a bond. It's just it's weird. It's how it goes, right? It's either cash or equities. So yeah, it's good.
I was reading through a bit of the comments on your website, actually, about your hesitancy to chase yield. So you've talked a bit about, Dimitri, about how your investment selections work, but in particular in the Unconstrained Bond Fund, if you're not chasing yield as a way to add performance to the fund, what adds your performance? I mean, you've talked a bit about it in the investment philosophy, but maybe you can either give more detailed examples or talk a bit more about the parameters around that fund, about what goes into it.
Absolutely. So what we mean by that, Tyler, is that we focus on total return, not on yield. And what the total return opportunity is what drives us. We think yield takes care of itself in that sense. So we, that's where that value discipline comes about, where we are playing for the total return component, including the price return component, which we think there's, if you are diligent and careful about the way you invest, you will capture some of that value proposition, and that will generate returns for you. And there are times, we never say we get the timing perfectly right. That's not what we, like I said, we are just reacting to what the market's giving us. So when risk premium is high, i.e. when you're getting paid, i.e. spreads are, attractive, we are getting paid to own them, because you are buying spreads when they are more attractive. That will give you some yield, as you mentioned, which is part of that total return. But we are also playing for the fact that there is a significant component within fixed income that is the price return. As you've seen in these last two years, it can go both ways. You can have these big months where fixed income total returns can be pretty negative, but it can go the other direction as well, as we saw in the last quarter in 2023. We play for both components. We are looking for total return is the focus, and we think part of that will be yield as we wait for risk premia to kind of mean revert. But we are also playing for that price component, which we think the way we invest, you do capture quite a bit of. And I'll give you a few examples. This value discipline, especially when you comes to drawdowns, right? If you look at the last 10 years and say, look, give me the 10 largest drawdowns that you've had or versus your competitors have had in the last 10 years, and look at the month before the drawdown. So you look at the biggest monthly drawdowns that you had and compare yourself. Okay, when you have a drawdown, what is your drawdown versus how much do you catch it up in the next month, in the following month? We basically capture all of our losses in the next month. Obviously, it's not every single time, but on average, we capture 95% of our losses that we had in the previous drawdown within the next month. You compare that versus our competitors, that's closer to maybe 2/3. They capture about 2/3 of it. And the reason is because they are basically riding out the cycle. They are owning the same things. They're not really actively changing their exposure. We are actually, when we are going into the drawdown, it's not that we are perfectly timing it. That's not it at all. But we are actually adding to our exposures as markets going down, because we are being disciplined value investors, because we feel, as I mentioned, 90% of what the spread compensation is not coming for default risk. It's coming for these cycles of fear and greed, where liquidity premia goes sky high, mark to market risk premia goes sky high, and we're just waiting to earn that. And the fact our strategy of being disciplined value investors and investing, not being fully invested all the time, allows us to allocate capital at the right time to be able to get that upside. So that's an example of how we generate value. And David, you made an interesting comment about, hey, look, some of our managers tend to be a little bit more constrained. And, I think at the end of the day, the way we look at it is, what type of risks have we taken? Say, for example, in the last 10 years, if you looked at our volatility of our fund, it matches the volatility of the US Ag. So it's not like we've taken a lot more volatility along the way to generate these returns that we're doing. We're generating it with a similar bond-like, fixed income-like risk, which tells you that there is value to be added by being, tactical and being disciplined around the value, around value. So that's kind of how we generate our returns. And going back to that answer, it's part of that will be income, but we don't focus only on income like some of our competitors do, where they're saying, look, we want to have a certain income overweight, and we're going to do what we need to get there and invest that way. I mean, that's one way of going about it, but we just think our strategy over the long run is going to be superior to that.
So price return eventually leads into a yield return if you've done it correctly and bought in value. Yeah.
Mm-hmm. Exactly.
Great. Yeah. Excellent.
I think, looking at, where we are today, short, medium term outlook, I think so far year to date, I think most bonds are in a very flat or just a slight negative. Are we kind of in a sideways fixed income market right now? I know, we keep predicting that we're going to see some rates drop and everybody's playing that game, but it seems like that might get pushed. What's the sense of where you're positioning the portfolio? So,
David, our duration, obviously duration being the biggest driver right now, is closer to about 3 years in the portfolio. But it was as high as 6 and change, close to 7, as I mentioned, a quarter ago, when real yields got to like 2.5%, things were really attractive. One of the things with the treasury market is how inverted the curve is. It's a negative carry trade to be, further out the curve than close to the front end, which makes it definitely a harder to own fixed income, relative to cash, for example. As I said, one of the things that we don't try to do is we don't spend a lot of time trying to forecast the future. But one of the things that we do realize is that as it comes to what's driving this, it's obviously the recent data as it keeps moving around. The Fed keeps changing their views, and as a function of that, the market keeps getting whipsawed. And to us, the way we are playing that is the only consistent thing that we can expect in some sense is that it's going to be volatile. So being tactical, once again, is going to be what wins over time. So the way we think about it is that Look, there are times when the market goes in one direction or the other, it's stretched in either direction. We're going to go in and take advantage of that. But yeah, it's going to be hard to call. To me, it's not an easy call given where we are, given how much is already priced into the curve, where the market's still pricing in close to about 100 basis points of cuts over the next year. It's hard to say that we're relatively cheap right now. We think we're close to fair value, if anything, maybe slightly more attractive than fair value. But it's not like we're taking a big bet on duration right now, because we just think that at fair value we have some exposure, but it's not something to write home about.
So would that be currently in your portfolio are you then sitting more cash heavy than you normally would? You don't see a lot of opportunity, I guess, in the current market to deploy? We
try to glean what the market's telling us in some sense. And obviously there's a contemporaneous look on growth, and then there's a forward-looking view on growth. The contemporaneous is that, hey, income growth in the US is still running at close to 5%. So people have a lot of money and consumer spending is 70% of the economy. That means the economy is doing okay. And so from a contemporaneous look, obviously that doesn't have a forward-looking view, but that's more of a contemporaneous look. And so we think still things are fine. That's number one. Two, if we think about from a forward-looking standpoint, we try to glean, as I mentioned, from the market, what the market's telling us. And what the market's telling us is that we tend to look at what cyclical stocks versus defensive stocks are telling us. This is an indicator that we've had for a long period of time. And this is not looking at any of the Magnificent Seven or anything like that. This is really focusing on things that are sensitive to growth, like railroads and regional banks and household, building products and stuff like that. So how are those performing relative to, really cyclically insensitive stuff like household products or pharmaceuticals and so on and so forth? What that's telling us is that right now, the market's saying the growth is as good as it's been in the last 2 years. Right. So since the Fed started cutting, started hiking in this whole cycle, the market's telling us that the growth feels fine. Obviously, we've also had 6 straight quarters of above 2% growth for the US, which is kind of doesn't happen very often, that kind of consistency. And so look, we think growth is fine for the time being. We're not too worried about it. Inflation side, we think is likely to be more sticky than where what the market thinks it's going to be. Part of that is regarding housing. I know you have a similar issue over in Canada, but we think housing is still going to be an issue for the US, and that means that inflation is likely to be stickier than what the market's pricing in over the next one year, especially. And in that environment, we don't think the Fed has a lot of room to really cut rates. So as a function of that, it's a mix of that growth and inflation combination that kind of informs us as to, okay, how do you think you want to invest? So we, as I said, we don't want to be overextended in terms of duration, but at the same time, in terms of risk assets, we don't feel like we want to be defensive and not have spread in the portfolio, have some carry in the portfolio, which is why we are gravitating towards shorter duration spread product that is basically we're earning some liquidity premium, but adds, call it 100 basis points of additional carry to the portfolio, which we think is kind of a holding pattern for us to where until opportunities get attractive. If you look at credit spreads generically, spreads are in the bottom decile over the last 10 years, nothing attractive per se. So that's why you want to be, you still want to earn some carry, but kind of, and add some, as we talked about, add some yield to the portfolio over the short term, because the environment is likely to be more of a, it's not likely to be such a provocative one where we think there's going to be a huge drop in credit spread or increase in credit spreads or huge drop in equities or anything like that. So basically, it's a bit of a portfolio that yields relatively well right now, close to 100 basis points over cash, so call it 6% type yields. More of a holding pattern for us because valuations aren't attractive. So we are being disciplined about our process.
I guess what indice do you measure this fund against, and what are other indicators indice-wise that you use to measure your success?
So, being an absolute return fund, it's a bit of a tough one. We get hit on both sides somewhat. One is that people look at us as, hey, you're a cash plus fund. So, regardless of which environment you're in, you're supposed to generate cash plus 200 type. So basically, if you think about the Bloomberg 1 to 3 month T-bill index in Canada, plus 200 basis points is our target. But at the end of the day, people also look at us and compare us versus what the bigger picture US fixed income index returns are. And just so, for example, the US Ag. So those two tend to be the most heavily compared indices for us. Yes, one's more of a direct benchmark, one's more of an indirect benchmark, being the US Ag.
So basically on the kind of T-bill plus 200 points, I mean, the fund's quite successful, straight up against bonds. It's kind of right in that zone. I think it kind of reflects, I mean, for what we do in all of our portfolio, there's a cost to running all the portfolio. It's very hard to beat an index on a regular basis. So, our goal always is to get as close to the return as the index with the client's fees back in their pocket with less volatility. We always suffer that fate where people are always, well, you shouldn't beat the index. But in reality, with less volatility and a lot of the costs returned, that's probably more the name of the game, but it's not the kind of thing that a lot of people look at or a lot of people want to measure. They want to measure just what they can see on a graph.
It's one of those things. It's always a bit of an uphill battle. We know what the discussion you're talking about, David. And so, but for us, we try to take a longer term view on it, and we know over time that we're gonna handsomely beat our benchmark and feel confident about it. But over a short term period, yes, we think you should always be taking a longer term view on it. But obviously, short term does matter for our clients, and we do have to pay attention to it as well.
I've got one more question. If you were looking at an overall bond portfolio, what percentage would you say? Obviously, you got a bit of a hometown bias here, but what percentage is in unconstrained compared to a regular bond pool? Is this a 50% of your total fixed income holding situation? What would you think?
The way we think about it is, so basically, depends on how you allocate to unconstrained. So the way we've thought about it is that if you think about your overall fixed income pie, there's going to be a risk-seeking component and a risk-mitigating component of it. So what you're supposed to do is, let's assume, obviously depends on on your overall portfolio, number one. But let's assume you're a 60-40 portfolio. You have a lot of 60% in equities, 40% in bonds. Within that bond component, let's assume you're running 30% in US Ag type product, and then 10% in more of the high yield type product, more of the return seeking component. So, obviously two things that are doing, different things for you. The way we think about it is that you should allocate some of your, call it 50% of your, 50% or not 50%, but say, let's assume you want to allocate, call it a quarter of that to an unconstrained portfolio. So basically 10% of your 40% allocation. And I would take 5% of that, take it out of your risk-seeking component. That's from the high yield. Take that out. And take 5% out of your risk-mitigating component. Take that out and allocate that into this. Because basically what you're saying is this fund is going to be able to mitigate, being able to travel to both sides of that. Either be very conservative, add a lot of duration to your portfolio, or be aggressive and add a lot of high yield to your portfolio. So you want to kind of allocate it from both sides of that basket. So more of a holistic view. Obviously, if you have less equities, then you can have more in fixed income, and you can allocate appropriately depending on that risk seeking versus risk mitigating component of your fixed income. But the bigger picture thing that we think about is, hey, you should allocate equally, take it out equally between your risk seeking and risk mitigating fixed income. And we think that our portfolio will outperform that over time quite handsomely.
Easy.
So 12.5% high yield, 25% unconstrained, and 62% US Ag.
Sounds about right. Sounds good to me.
We'll apply that to our 5% fixed income holding for every client. No, it's higher than that, but yeah.
Well, that's great, Dimitri. You've touched on most of my questions. I don't know how you're doing for time, but we're bumping up against our normally allocated amount for you. So if you have any comments, feel free to shout them out now, or if you like, we can wrap up as well.
Oh, so let me, I guess, quickly summarize. I guess, look, to us, the product, as I said, we've got a long track record of doing this successfully. The reasons for our success is threefold. I would say one is is the playbook that I mentioned. It's a simple playbook, but it's a well thought through playbook. Though it's a simple but well thought through playbook. Number two, it's a team that has really got comfortable doing uncomfortable things. Most people don't like buying when the market's going down a lot, or like selling when the market's going up a lot. We have really built that value discipline, and it's almost muscle memory for our team now. It's almost going against the natural psychology of investors, and that's something that we've built up over the years, which I think is really valuable. Number three thing as to why we're successful is that we did talk about how we are a smaller firm. We're a $27 billion firm. One of the attributes to that is that we can actually be active. We can actually, if you think about the liquidity environment in the last, especially since the global financial crisis, it has fallen very significantly, meaning what the street will be able to intermediate for you, how much of your portfolio you can reallocate at any given time has gotten much worse because this, liquidity environment has gotten much poorer. So for a smaller firm like us to be able to execute our playbook is a lot easier. We can actually generate value for our clients by reallocating to different sectors or different securities through time, because we are a smaller firm and the market is much more capable of handling a flow like ours. For example, I worked at a firm that had 10 times the AUM of what Reams has, and you could not execute this playbook, even if you had our playbook, or even if you had the same sort of mentality and the team that could execute that playbook. Practically, you cannot execute that playbook because the market would not allow you to do. You're too big of a ship to kind of really steer the ship significantly. It's really so, which is why some of those bigger managers are going to be relying more on income and are being fully invested through the cycle. For us, our ability to really, move the portfolio around is important, and we can, and that's because of our size. So, and to, at the end of the day, that should be what should be better to our clients, end result, and we can generate those end results as a function of it. So I would say those three reasons are why over time, we have a, beaten high yield by 200 basis points, but without taking, the same types of risks over time, beating the ag by 400 basis points, and tend to be, lowly correlated with other fixed income indices. So it's a interesting, right? That's a holy grail in some sense. High returns and low correlations, if you can achieve it. We think we've done a relatively decent job over the long term, and we are very excited about the future. I mean, look, if you think about the firm, it's Wayne talked about how Canoe is really growing. We are growing fast as well. We, last year, organic growth for the firm was close to 18%. That's relative to this business, which is, if you're in the low single digits, you're pretty happy. As you guys know, this is a tough business. We're growing and growing for a reason. But we're still tiny compared to most players, $1 trillion managers that, of course, everyone's heard of. We are somewhat of a boutique. We're somewhat niche in that sense, but we like that because it allows us to actually execute our playbook and generate returns for our clients.
That's great, Dimitri. Awesome. I guess we can wrap up here then. It's been a pleasure speaking with you, and we thank you again for your time that you spent with us today. It's wonderful to have Canoe Financial as a partner, and they've picked a fantastic manager to fill this gap in their portfolio offerings. So thank you both to Wayne and to Dimitri for joining us today. If you want to learn more about us, check us out on our socials. Head over to smokinbulls.com and click subscribe if you like this video. Thanks again, guys. Appreciate it.
Thanks very much.